Like, what do you do with something this specific where the risk reward may be very large, but the time to get there is also very large?
Right. I mean, I think the most immediate place the market's going to go is maybe it restrains the valuation of these companies. It caps the valuations. If you look last year at the highs in these stocks, and pretty much they're all down 20% or so from their peaks, the valuations and the reason that they were sort of the go-to for everybody for growth was that their growth long term was almost automatic, and the platforms were impenetrable, and those are exactly the reasons that they're under fire. So I do think that you can say if they can show continued earnings growth, you count on that. This is the kind of market you'd probably see a little bit of a reflexive rotation into big cap growth stocks like these, simply because growth in general is kind of challenged, very low yields, looking for steady cash flows. So I don't think the market's going to make much of a business, though, of trying to handicap outcomes and figure out breakups and those types of values and things like that. For now, it's just a little bit of a shadow that's going to be with us.
Mark, are you spending time doing exactly that?
Well, I think Santoli's right. If that was my, I think there's going to be a limit on the multiples. I think the peak multiple will probably be trimmed down. Let me put it this way: prior to Cambridge Gate, the challenge that Facebook had last year when it was uncovered, that stock was trading at around 25 PE multiple. I'm not sure if Facebook can easily get back to there, but I think the difference is like 22, 23 times earnings rather than 25. I think there will be a little bit of an overhang. And by the way, I think the key point is it's going to affect multiples. It'll affect the PE. It won't affect the E. I don't think you're going to see any change in the top line growth rates for these companies, Amazon, Facebook, and Google, because of regulation. And I don't think you're going to see any material impact in terms of margins. There's already increased spend by all of these companies in order to comply with regulations. I don't think there's any needle mover, new needle mover beyond that. We continue to like the assets, and particularly like Facebook first, Netflix second, in part because they probably face by far the least regulatory risk of any of these platforms.
Mike, the markets in the last couple of days have in large part rallied because there is this notion out there that the Fed may be more amenable to cutting rates if necessary before the year is out. If you do see something like that play out, does that make the FANG names and these big cap tech names that much more attractive once again as investors hunt for yield and hunt for growth?
I don't know that would be the first trade, simply because so many other parts of the market that are much more cyclical are more depressed. So I think that the precondition for this bounce we had yesterday was a lot of stocks down a lot. So I think that the snapback would probably be led by the stuff that kind of looks junkiest right now. It needs more cyclical growth, whether it's depressed consumer discretionary or it's autos or something like that. But longer term, if we're in a low-rate environment for a long time and this sort of ratifies the idea that overall global growth is not going to be accelerating, yeah, I don't see a market that continues sort of marching ahead and remaining supported somewhere in the general vicinity of the highs without these stocks being a big part of it. I don't think it's going to be a wholesale rotation away from them.